Good evening, everyone. Thank you for joining us this evening on how to pick the best mutual funds. I'm Crystal, the community manager at ProsperUS, your host for tonight. With over 5 years of experience in banking and the investment industry, I'm now focusing on building the ProsperUS brand among the millennials. Let me start off by doing a quick introduction of ProsperUS. ProsperUS is a digital investment service launched this March to cater for the millennials by the millennials. We aim to provide you with the best in-class service. And as part of our educational efforts, we have specially curated series like our webinars for millennials to gain more insights on investing. So with ProsperUS, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. To cater for your investing convenience, we have recently launched the ProsperUS mobile app, so do head over to Google Play or the App Store to download it today. Follow us on social media like Instagram or Telegram to keep yourselves updated on the latest news. For this webinar, we have invited our very own Tim Phillips. I'm pretty sure some of you are very familiar with him. He's our content composer with over 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. Tim believes that successful long-term investing is within everyone's reach. Next up, we have Jake, an Associate Director on the Discretionary Portfolio Management team at CGS-CIMB Securities. His primary responsibilities include managing discretionary investment mandates for the team, conducting quantitative research to uncover new sources of alpha, building proprietary strategic tactical asset allocation models, multi-factor equity strategies, and mutual fund selection models. He holds a Bachelor of Business majoring in Economics and Finance from RMIT University. He is also a Chartered Market Technician, member of the CMT Association and co-chair of Singapore CMT chapter. Allow me to do a short introduction on private wealth. Private wealth actually offers an integrated suite of financial products, personalized service to grow, preserve, and leverage your wealth. Private wealth develops their own asset allocation models. Some of their products include equities, fixed income securities, derivatives, mutual funds, and structured products. They have recently launched discretionary portfolio management service to offer customized and standardized solutions to meet clients' investment goals. So without further ado, let's invite Tim to share with us his views on mutual funds.
Hi, thanks, Crystal. Hello, everybody. So I think before Jake speaks, I think I just wanted to quickly go through my own thoughts on mutual funds, just to try and give a more holistic view, maybe from just a person who isn't in the fund world or the fund industry. And I think they definitely do serve a really good purpose within portfolios if you have if you have specific strategies that you want to pursue. But I just want to run through, first of all, the pros and the cons, just to be, completely balanced about how I view mutual funds, today. So I think we can start with the pros of a mutual fund. It obviously gives you diversification. So as soon as you buy a mutual fund, you're exposed to a basket of stocks, right? Whether that is concentrated across maybe 50 or 60, or it's a larger basket of stocks, depends on obviously the fund manager and the strategy that you're investing in. But regardless, whatever strategy you do invest with, you will gain diversification. That's definitely a positive. Second, you have the professionals managing it. So money managers and research teams, they are obviously schooled in this kind of, fundamental analysis, as well as understanding the market, understanding where certain companies' directions are going, what's happening in the market. So you have to put your trust into those managers to deliver, alpha, which basically means beating the market. And that's another thing that comes onto the third point, right? There is that potential to beat the market. So obviously identifying the right funds is really, really important. So you have to be invested in the right funds, in the right managers to actually generate that alpha for your portfolio. And then finally, I think it gives you a bit of flexibility, right? You can start with small amounts. You don't have to buy a massive a lot of shares like you would maybe in Singapore or Hong Kong, where you have to buy 100 shares or 500 shares or whatever. You can put in as little as I think $100 a month if you want to. So that gives you the flexibility to start small, to ramp up, to sort of scale down if you want to. So I think for people starting out, there's definitely a positive to a mutual fund. Okay, so I think for me, the cons, I think I'll just be honest with where I see the cons. Primarily it's costs, right? So the fees that you see with mutual funds are much higher than you would get with an exchange traded fund, which can give you fees as low as maybe 0.1, 0.08. It's getting close to zero with ETFs. Whereas with some funds, you have a sales charge, you might have a annual management fee, and then obviously like netted out, what is the actual total expense ratio? So I think that's the key that you have to focus on. And for a lot of funds, the total expense ratio, which is, obviously the TER, that can be ranging from sort of 1% to 2%. So obviously think about how that is extrapolated over 20, 30 years, that will cost a lot of money. So that's something that you do really need to be wary of, and whether the alpha that they're delivering, the managers, is offsetting the cost of what you're paying in fees. I'd say the second thing for me is the single manager risk. I think there's a real tendency to maybe gravitate towards some really good managers that have done well and have good performance, but then what happens if they've not got a team behind them that is going to be able to maintain that performance once that person leaves? So you have to really understand the team you're invested into, or the fund that you're invested into, and how they manage that fund and how they see performance and how they generate that performance. And then finally, you have the mirroring and index hugging, which I think has really been a big problem in the fund industry. It basically means that because they're too scared to underperform against an ETF, they'll just mirror the ETF. So they'll have maybe 5 or 6% in Apple, and then obviously the S&P 500 has 5 or 6% in Apple, and they'll have maybe 7% in Amazon and Microsoft, and then the ETF might have, the index might have maybe 9%. So there's little discrepancies here and there, but it seems like they're actually just hugging against the ETF, and obviously the lines of performance are really, really close together. So that's a problem, and you kind of then wonder, what are you paying for, right, if they're not going to deliver that alpha? So I think that's something that you've got to really be cognizant of when you're investing. I think before I hand over to Jake, I'll just kind of give you my own views on how I think about where I would use a mutual fund from my own personal perspective. I think when investing, it's really important to understand the benchmark that they're comparing themselves against, right? So I think in the US, with a lot of the fund industry underperforming, it does seem to lend itself more to ETFs. I think that's something that a lot of people have obviously cottoned onto, and you've seen massive flows into ETFs over the past decade. But in Asia, I think if you're looking to access maybe harder to get to markets like in India or Indonesia, like single markets, which you probably wouldn't buy stocks in, because you may not be able to access it at all, such as India. You can't actually buy unless you're an Indian citizen. Or maybe it's a bit too troublesome to set up a brokerage and buy Indonesian stocks, or Philippine stocks, for example. So I think there are certain pockets of opportunity where you can use an active manager to pursue that, a mutual fund. And then obviously now with China, I just did a talk yesterday with Seedly on just the crackdown in China. I think with policy in China now going forward, you're going to understand that regulators are going to play a much bigger role in the economy and in the tech space, which obviously I think, had taken a step back previously. And I think that will lend itself a bit more to active management. So if you're looking at managers who are managing China funds, they're going to be able to pivot more quickly and be more nimble if they don't have to track a certain index, or if they're not in an ETF where you have, maybe 10% in Tencent and then 5% in Meituan, 10% in Baba. So I think it gives managers a bit more flexibility to adjust the portfolio according to what the Chinese government is thinking. So I think there are definitely certain situations where mutual funds are warranted, or maybe do deserve a look in terms of portfolio allocation or asset allocation for your portfolio. I think for me, that's it. I just wanted to kind of cover that quickly and pass it on to Jake, because Jake has got some really interesting perspectives on the fund industry, and obviously an expert in that area. So I'll hand it over to you, Jake.
Maybe before we hand over to Jake, why not let's take a poll to see
Yeah, let's
what
do the poll. Okay.
percentage
Yeah.
of the audience's portfolio actually consists of mutual funds. I think a majority of them has already voted. Let's take a look at the results. So from the results, it's quite interesting.
Yeah.
Majority of them don't have mutual funds in their portfolio.
Right.
Yeah. So any advice or is there like an optimum percentage that the audiences can actually consider to incorporate mutual funds into their portfolio?
I think it's a very individual preference, just like stocks, just like bonds. I mean, at least if you're in a mutual fund, I assume you're most likely in a stock fund, if not a multi-asset. But the majority is probably equity, which is, at least you're not in bonds, or if you're not leaving your cash, idle. So I think as long as you're investing, that's positive. I say, I just think it depends on, are you getting value for money? Are you getting the performance that you desire for the cost that you're paying? So I think that's a key question that everybody just needs to ask themselves when they do invest. But I think Jake has got some really good insights. So he's going to share some really good insights on how to identify the best ones, or to really understand how you can identify the best performing ones. So maybe we should hand over to Jake to cover that.
Hi, Tim.
Hey.
Thanks for covering so much ground in such a short time.
No problem.
Yep. Just let me share the screen. Right. So thanks, Tim, for covering so much. And I think I'll just skip to some of the key things that is more interesting. And it's actually a personal agenda for me to find a solution to really identify or find a better way to screen out the better performing funds, so that it's a much easier investment process for investors. Because I've started investing myself 18 years ago. And yeah, one of the key things that it's stopping or it's holding us back is, how do we tell, which one is better than A over B, right? And with the kind of information available in markets, and or rather the lack of information and the opaque situation when you try to compare funds in some ways, it's just very different, because it's not like a stock whereby it's quite easy for you to compare the P ratios, the balance sheet. For funds, because of the way it's structured, so it's very hard to do a straight A to A comparison of two different funds. So over the years, I've been scratching my head and trying to come up with ideas. And of course, I believe over the years we have, or rather, we have find a solution. In this case, we have created a model to help investors and even people like us to identify funds that potentially we can incorporate into portfolios to help us to achieve the desired exposure that we're trying to achieve. Right. Of course, one of the key things that we need to understand is the underlying exposure in the funds itself, which sometimes, if you just rely on the mutual fund's name, can be very misleading. I can quote you 101 funds out there which have names that do not properly describe their portfolio strategies at all. Yeah, so sometimes it's misleading. So for investors who want to invest in mutual funds, will have to dig a little bit further to see what's inside. And of course, the next key thing is relative performance. So this is not easy for most of the investors, or rather retail investors, because you have a ton of information out there. Even though nowadays it's Google, it's quite easy to compare or extract data for most of the investors. But to put them together and compare, that's a different story. So some performance metrics that we look at would be things like your information ratio, Sharpe ratios, so on and so forth. Of course, one of the key, I would say one of the key things that a lot of investors are missing out is on the risk-adjusted returns. What we do notice after dealing with investors for so long, people are very focused on the headline results or the headline performance, whether Fund A can deliver 10% returns or Fund B can deliver 20% returns. But we have to understand, are they giving us the same risk-adjusted returns or higher compared to, to Fund A or B that you're comparing against, or in fact comparing against the whole segment or the whole industry, right? And of course, not forgetting the fact that most of the funds are long only. So how are they going to manage their downside risk? A lot of the funds will go through a bad patch, especially during the market correction, bubble burst. You will see a lot of funds do not have a hedging mechanism. They will just follow the general market and pull back, or go into a very deep drawdown. So we would have to also examine how these funds react in such a situation. And some of the common metrics that we use would be max drawdown, recovery period, post-max drawdown, and some of the volatility metrics that we look at. And of course, the people and the management behind the funds, right? Of course, it's very difficult for anyone to track the movement of the fund managers. It's not easy, even if you utilize a lot of machine learning or all the AI techniques out there. It's not easy tracking them because there are hundreds of thousands of funds. Yeah. So knowing the fact that this is a handicap for a lot of investors, we can actually just simply go to Morningstar, where they have a lot of information on the movement and the tenure of the fund managers managing those specific funds. So for you guys out there, I would just encourage you sign up for Morningstar. It's free if you want to track the people managing behind funds. Right. So these are the 5 key things that most investors should pay attention to and look at when they start to compare funds and to decide whether it's feasible or it's reasonable to invest in a particular fund, right? And of course, to overcome this problem, what we have designed so far along this line, it's a risk model, right? A quantitative fund screener, which we call the CQM Mutual Fund Screener. This model predominantly comprises of 3 key risk matrix that we look at. First would be relative outperformance. Second would be risk-adjusted returns. And third is the downside volatility. Of course, the other 2 factors that I mentioned earlier, it's harder to track, but be rest assured, because somehow, not somehow, or rather let's say the assets that are within the portfolio will show up in all these metrics that we're looking at, especially in the Sharpe ratio and in the relative performance. Once we are able to draw all this data, put them together and pass it through the model for screening. So essentially, this fund screener, it's a multiple regression model that's designed to handle a vast amount of data. Unlike a spreadsheet that you just pull in from Yahoo, it's much stronger than a spreadsheet can do. And of course, the key objective is to create a model so that we can objectively and consistently evaluate all these metrics, so that we can conclude that why this group of funds are performing much better, right? So essentially, this is a way to consistently rank them at the same time, because we put all the data through the screener. We pass it through, right? So all this data it's just numbers. It's very objective. It doesn't favor, let's say, fidelity over black box. It basically takes all the numbers objectively and evaluate them. So this model will generate a numerical score, and from there we will rank them into 4 different quartiles before we give them what we call a CQM rating, with 1 being the worst and 4 being the best. This idea, it's I would say it's easier than to compare them or to just let people look at the score, because it's a lot of numbers. So when we put them in a basket or in a bucket, it's easier, right? So we have a rating of 1 to 4 or 1 to 5. It's easier for people to evaluate. Of course, once we have done that, we will decide to, or rather, we will put all the top ranking funds into what we call a FundsPrimo. FundsPrimo is effectively just a short list of all the top ranking funds within all the different segments or universe, averaging about top 10 to 15 percentile across the entire product universe. So all these top ranking names will go into what FundsPrimo, and usually we will have about 35 to 40 names. So that's easier for people to identify and to match their investment requirements. Of course, in addition to this 35 or 40 names that it's inside this FundsPrimo, we have actively also picked up some of the top ranking names that has the least overlapping geographical exposure within this group of funds, so that we can straight away highlight to clients or advisors that these are some of the names that you should be focusing on, instead of looking through that list of 30 to 40 names. And of course, I believe a lot of people want to know what's the output, right? How do we know whether this output is valid? And of course, you can see from here, this is basically the top 10 of our, or rather, top 10 of the multi-asset segment within the universe. This universe have about, I believe, about 40 names. Yeah, so we are taking the top ranking names to highlight and showcase that these are the top performing funds within this group. And in this portion over here, it's a fixed income segment. So you will see we have a rating of the funds over here. And coming to the equity bucket, because this is a more popular universe, so you have more options for people to choose from. You won't be surprised to find that a lot of the technology funds are actually amongst the top by virtue of the fact that statistically, when we look at empirical research, technology is the driver of changing any economic regime. It's always pushing the boundary of industrialization and all sorts of economic development. So statistically, when we look at the funds universe, technology is always the outperformer. And of course, being the outperformer, you also carries more volatility and more downside risk if you happen to pick them at the wrong time. So within this list, you will see some of the very common household fund issuers that you see. More often than not, you find BlackRock to be, they're not to be biased, but BlackRock is the largest fund manager in the world. So by virtue of the law of large numbers, they have quite a fair bit of good products out there. But if you were to look at the whole entire list or the whole entire universe, you won't be surprised to find some of the or rather the more average BlackRock funds in the middle or the bottom of the pile. Right. So the key objective of this screening model is to identify which are the stronger ones. And this is a screenshot from Bloomberg, right? So you can see I picked the top 3 ranking global multi-asset funds to compare against the bottom 3 mutual funds, and you can see it's very clear that there's a outperformance gap, right? So this gap, we can calculate a spread over it, and it's very obvious that this model is doing its job and is able to screen out which are the outperforming ones without giving too much weight to, are they from BlackRock or are they from Schroders, sorry, are they from Fidelity? It's agnostic to names. We just want to find out which are the ones that potentially can give us better returns in the future, because these are the better managed funds. These are the funds that have shown to have a much better consistency over long periods of time. So this validates the effectiveness. And of course, the bigger question I think over here would be, can any of them do much better than a 60-40 ETF portfolio, right? It's always the big debate between the active and the passive guys. And I can only say there are funds out there who potentially, or who has done it consistently by beating the benchmark, by beating their peers, by beating an index ETF portfolio. There are guys out there. It's just a matter of, do we have the tool to screen out all these names efficiently, as efficiently as possible, without going through, let's say, hours of research or days of research to really get to the conclusion. Or either that would be your financial advisors trying to sell you something that perhaps will give them a higher commission, right? So all this are meant, or rather, all this are meant to help investors to make a smarter and better decision by taking out all the noise, disregarding whether this is the the hottest fund out there, right? So to sum up my presentation, there are mutual funds out there that can deliver comparable performance that is easily better than own benchmark index or any index ETF portfolio, but we just need to have a tool or a method to identify them. Yeah. So with this, I think I would like to end my presentation.
Thanks, Jake.
Yeah.
Thanks for sharing.
Yeah.
Earlier on, we actually did a poll with regards to find out what percentage of the audience's portfolio actually consists of mutual funds. So just out of curiosity, shall we actually do a poll to see what the percentage of the audience's portfolio actually consists of bonds?
Sorry, bonds?
Oh no, as in out of curiosity, right? Shall we do a poll with the audiences to find out what percentage of their portfolio actually consists of bonds? Hold on, let me pull out the poll. Okay, I think majority of them has actually voted. The results are actually quite similar to the mutual funds. So I can see that majority of them doesn't actually include bonds in their portfolio. So actually, apart from bonds, right? To be honest, I don't really invest in bonds. Any advice that you can actually give the audiences with regards to bonds? Jake or Tim?
I mean, my personal take on bonds is that it's just the yield, the yield has just been driven down, right, to zero. So I think there's a reason why there's that saying about Tina, there is no alternative to stocks, because bond yields have just been driven basically to zero. And then you're looking at negative yielding debt in Europe. I mean, only a few years ago, they're talking about moving interest rates in the US to or potentially going negative, but I don't think that's going to happen. But if there is, a spike in yields, then bonds are going to get hit really hard. As Seiboon has kind of written about in his column, he talked about stocks and if they get hit hard, but bonds, I think that's what we should be more scared of is bonds being hit really hard because they've had a bull market for the past 30 years. So I can understand why a lot of people don't have much in bonds.
As for myself, I personally don't hold bonds. I don't see the need to have bonds, at least for my own personal portfolio, because I like the risk premium that equities gave me. So plus the fact that I can take the volatility that comes along with it, because the statistics are way behind equity risk premium, right? So for anyone, especially when they're starting to build a portfolio from a young age, it's relatively okay to go more aggressive on equities over bonds. But of course, the investment theory back then suggests that 60-40 and having a balance, it's good. I'm not saying it's bad, but the thing is, we all have to understand, do we have the psychology to accept the kind of volatility that comes along with it? I can tell you a lot of my friends who invest together with me back in those days, they will try to time the market, especially on the call investment side. So more often than not, they will do a lot of bad timing positions, and some of them could have been left behind because you try to time it and you are totally out of the market. You feel the get back in. So a lack of strategy and discipline will somehow fail the investors who simply wants to trade their investments. Right. So for an investment portfolio perspective, I would say it's okay to have a balanced portfolio, to have some bonds if you think that you can't stand the pure equities exposure, because naturally at some point things will build up, it will go into a frothy state and it will burst, right? But that burst is actually a good, healthy scenario where technically the markets mean revert to reasonable valuations, and it's a good time for entry. But more often than not, you see people doing the opposite. When the markets crash, they sell, right? So they end up selling low and buying high. Yeah, so in a nutshell, they don't have strategy to begin with. They try to trade investments. They don't try to build an investment portfolio, right? So that approach is quite wrong to begin with, because I always tell clients or friends, you need to build an investment portfolio, and the whole idea is to increase your assets so that by the time you reach, let's say, time for retirement, you have a large pool of assets to draw down. Of course, does those assets comprises of all equities or bonds? That's a question that it's dependent on your situation or your ability to handle risk. Because the more equities you have, it's very likely you can't handle a market crash, right? You would panic and you would sell out. And lucky me, I sat through 2 booms and busts, and the average returns from a call equity position or a portfolio returns about 7.3, 7.4 annualized returns. And when you translate that into 18 years, right, this number is about 13% in nominal terms, right? So that's a fairly good gauge for anyone out there who wants to invest and think, for the kind of returns, can I withstand the kind of risk, because the market will eventually correct itself, right? Personally, I don't quite agree with a lot of commentators out there when they say the market crash, because by all means, I can show statistically the markets are just correcting to its mean, or what we call mean reversion. So that is a very natural and healthy scenario whereby you are resetting back to normal, right? So more often than not, things are a bit out of their norm, right? Or rather, it will be a prolonged state where valuations are crazy, but nobody panics, or rather, there's no crowd panic, right? So everybody feels it's okay. Everything is going to move in a straight line until something happens, which we are in no position to, or rather, it's very hard to say when, right? So timing the market, I would say it's not impossible. It is possible, but it's very hard to do so. You need to be trained in that area, and of course, when the trigger comes, when the signal comes, you need to squeeze the trigger. In this case, you have to decide: are you trading or investing? Like I said earlier, a lot of people are doing a lot of investors are doing exactly the opposite what they should be doing, and a lot of traders are doing the opposite what they should be doing, right? So that creates a problem, because people get disheartened in their investment or trading journey, and on top of that, because there are a lot of distraction out there, a lot of trend. Let's say now it's I would say ESG is the trend, right? It's top of town, right? But the crux of the problem in this case is, yeah, ESG is good. It's good for for the world, but then again, are we pushing valuations beyond reasonable levels? And at some point, people will realize that it's out of whack and it will go into a correction. Right? So these are the kind of things we have to ask ourselves. How should we construct our portfolio to begin with? Yeah.
Okay, thanks, Jake. I believe apart from bonds and mutual funds, right, there are actually quite a number of investors who are actually looking at ETFs. So which is actually better, mutual funds or ETFs? Jake or Tim?
Let Jake take
Okay.
that. Yeah.
Okay. First of all, we have to understand whether it's an ETF or a mutual fund, they are both just wrappers around a strategy, right? So, of course, a lot of mutual funds, or a lot of people associate mutual funds with active strategies. True and not true, because the first index fund was actually a mutual fund, right? So it all started in 1975, 76 when John Bogle, right? I'm sure a lot of people are very familiar with John Bogle. He was one who created the first index mutual fund, but his idea was actually originated from Samsonite pension plan, where they, where they ask question: can we create something that instead of trying to beat the market or trying to do stock selection, can we do something very passive? Can we do something along that line? So that was the birth of the first index mutual fund. And of course, as time progressed, we happily forgot that the first index fund is actually a mutual fund. So if essentially it's just a wrapper behind a strategy. And of course, right now we all associate ETF with index fund. But as we progress, now the trend for index mutual fund world, it's mutating along the active management segment, where a lot of managers or a lot of strategies out there that tries to differentiate from very passive strategy is coming into the market. Of course, I'm not saying which one is better in this case because it depends on the strategy. Because the downside of index ETF is purely index and it's market cap weighted. So that is the disadvantage of index ETF. Yeah, so I would look at it from a strategy perspective instead of a wrapper perspective. Yeah. But of course, fees also plays a part, right? I would love to have a mutual fund that charges reasonably. Of course, the reason why ETFs can be so cheap is because of the technology evolution that we can manage more portfolios because it's easier to manage an index ETF or index mutual fund because of technology computing, development in big data, things like machine learning. It all makes the management of the strategy much easier, whether they are wrapped in a mutual fund wrapper or a ETF wrapper.
Cool. I guess I can do my thoughts on ETFs versus funds. But before that, I just wanted to share an upcoming webinar that we're actually hosting. A couple upcoming webinars that we're hosting that hopefully listeners should be interested in. So we are doing a couple on understanding risk. So first off, I think a lot of people think risk and volatility are the same thing. Conventional wisdom says that they are, but I think there are lots of people that also think they're not the same thing. So we kind of want to dig deeper into that and understand risk and volatility in portfolios. I think we'll take a look at smaller cap names. Do they move more than mega caps? They tend to. Looking at the risk curve and where you want to take more risk for, obviously better returns. Is the technology sector more volatile? Obviously, I think a lot of people think it is. I mean, how true is that, and will it matter to your returns in future? And then, how do we balance the volatility in your portfolio with, a bit more stability as well? And then I think everyone here in Singapore should be interested in this one with S-REITs. It's a big topic in Singapore, generating passive income. How do you identify the best ones? I personally like to pick individual REITs just because I think there are some really great best-in-class REITs. And I think the basket approach is also popular, but there's definitely an argument to be made for how to just get the best long-term performers and get those to be generating income for you quarter after quarter after quarter. So join us. That's in September, so you've got plenty of time to sign up for that. And our risk and volatility webinar will be at the end of August 26th. Okay, I'll stop there. Let me get back to the topic at hand. So index funds and mutual funds and ETFs. Okay, so I personally, for investment purposes, I think starting out, I think ETFs are a great way to start, just to be familiar with the actual mechanisms of the market and the machinations of what's happening in the market. Because, in the US, you have the NASDAQ and the S&P 500. Those indices really move markets, and the stocks within them are huge. So you're going to be understanding how the market moves with an ETF. And obviously that just tracks it. And the past 10 years has proved its popularity, right? The fees have come down. I think mutual funds, there's massive fee compression in the industry. So I think that's something that the mutual fund industry has been really fighting hard against. And it's a battle because they're going to have to come up with new ways to think about how they can generate revenue. So I think overall, the ETF industry has been good for the whole financial investment community because it's also made the mutual fund industry kind of lower their fees as well. But I think once you become more familiar, there's always an argument to be made to invest in active funds, active mutual funds. But as I said, I personally like to look at it from an individual market perspective, which is maybe less accessible, or where active management, the generation of alpha, is worth the cost that you're paying in fees. Because at the end of the day, you're investing to make money, right? You're not investing just for the fun of it. You want to make a return on whatever you're putting into the market. So you really have to be vigilant about measuring the performance against the benchmark. So even if there is a absolute return, or you're getting a positive return, that's also very relative as to how it compares to the benchmark that they're performing against, right? So if they're underperforming a benchmark, you might as well be better off putting in ETFs. But obviously, there are really good funds out there, as Jake has highlighted. So it's really important to identify the good ones and whether they fit the profile that you're looking for. But I think it is a very individual preference for both. So I think there's, there are arguments for both, but I think I tend to lean towards ETFs just being accessible for most people. But I think there's definitely arguments for both, for sure.
Of course, totally agree the fact that ETF is a very good starting point for everyone to create portfolios with. And on top of that, yes, if you want to use, let's say, ETF for your call positions, you should really focus on using especially the US-centric ETFs or those with US exposure, because I've done my own research, and a lot of active managers indeed have problem getting it. The S&P Dow Jones have published regular papers year on to say only about 15% of the active fund managers is able to do better than the index or the benchmark index. So therefore, it's this 15% that you're talking about that is able to deliver alpha. So it's a question of looking for that, right? So in non-US or developed markets is also quite competitive. The numbers is around 20%. And of course, in emerging markets is the place for, I would say, the reason why people can potentially use mutual funds as a satellite or a tactical exposure, especially in terms of regional or single country exposure, because these are the places that are not efficient, or less efficient in that sense, because it's very easy to beat the benchmark index. I've done a lot of models myself. I've done a lot of back testing, applying my own strategies, especially US. I can tell you, due to the fact that there are tons of brilliant scientists or investors out there trying to create strategies, whether they are active or passive strategies, it's very tough to beat an efficient market like the US. In fact, I think I'm not confident of doing something that can consistently beat the S&P 500 myself. Yeah, so I would just rather use an index ETF to gain that exposure, because anything that you try to do, it's not able to squeeze out too much alpha from the efficient market over there. So I'm leaning more towards using US ETF for their positions over there, for their exposure over there, and for call positions in your investment portfolio. ETFs is a good way, and it's relatively cheap. It's fine if you, let's say, make a wrong choice, because it can't be too wrong, right? If you pick a big name index ETF over a mutual fund that you end up picking wrong, and you are reluctant to discard the manager. So it's definitely a safer bet to start with an index ETF, especially with US exposure. Emerging markets, we can definitely consider using mutual funds. But of course, some of the developing markets may not have the kind of ETF products that will be as efficient compared to their US counterparts. So that's an area that I believe the index issuers will perhaps take at least a couple of more years to come up with, because what we do notice in this part of the world is there are more and more ETF issuers launching products to cover specific areas or segments that is missed out by existing products. Yeah.
Okay, thanks, Jake and Tim. I believe we have some questions from the floor. Let's take a look at the first question. Okay, so the first question is, are Asian HY bond funds good to invest now? Tim or Jake?
Yeah. Do you want to take that first, Jake? Or?
Yeah,
Yeah.
Okay. This this kind of question is as good as asking, can we buy Sembcorp? Okay. I think as an investor, we have to ask ourselves, do we want high yield bonds in the first place, whether it's Asian or developed market high yield bonds? Because the very burning question is, if let's say you have already decided an asset allocation of, let's say, 60-40, right? Of this 40% of allocation to fixed income, do you want to have a bit of better performance? If the question is yes, I said, why not include or incorporate high yield bonds? But bearing in mind, high yield bonds behave very similar to equities, right? So if you ramp up exposure to high yield bonds, effectively your 60-40, it's not 60-40 anymore. It becomes 70-30, right? Because with higher returns, it comes higher risk, whether you use volatility as a measurement or you use drawdown as a measurement. It will show up in the performance, in the risk return profile of your investment portfolio. So I would say, if the decision is to say yes, it's okay to include high yield bonds in my investment portfolio, I can take the risk, I can take that volatility that comes along with it, I say yes, correct. It's definitely okay, because ultimately we cannot rule out the fact that high yield bonds will have a better risk premium over lower yielding bonds or safer bonds, right? But it's definitely an area to consider. And the key question is, do not get yourself overexposed. Always stay within your constraint, your design, or your predetermined allocation, right? Not because of, let's say, bonds is, well, if you think bonds will give you high returns, do not, I would say, be disciplined enough and not pursue performance at the expense of your overall objectives in your asset allocation.
Okay, thanks, Jake.
Yeah.
Tim, do you have any views on that?
Yeah, I think I agree with Jake's point of view about understanding your risk profile as well, and understanding the amount of risk you're willing to take, because obviously with that yield bump, you're going to have to take on a specific amount of risk compared to lower yielding safer bonds, right? With corporates in in the West and in higher sovereign rated sovereigns, rather in terms of the bond market, I think obviously yields are really low, so people don't want to be there. So then people are moving towards higher yielding bonds, and that's obviously in Asia, but it's still a developing market. So you have to be cognizant of the risk involved and whether it's worth taking that risk for your portfolio. But again, you have to really keep it within predefined,
Threshold.
Yeah, for sure. Right. Don't overexpose yourself to that, because it can turn quite quickly.
Correct.
Okay.
Yeah.
Thanks, Tim. Can we take a look at the next question? Can you share the funds that outperform ETF?
It's that with reference to what I've shown earlier.
I think the question that was posted, yeah, I believe so.
Okay. Just bear in mind, we're not promoting we're not promoting that particular mutual fund. We are just let me share the screen. Right, so this is okay. From the results that I've shown earlier, that particular segment is in the global multi-asset segment. So the fund that beat a 60-40 iShares global allocation fund is Allianz Income and Growth. right? So yeah, but bear in mind, this fund has got 30% allocation to high yield bonds, right? So that's one of the driving factor that this fund actually outperforms a 60-40 fund. Yeah, but of course it's quite consistent because you can see that throughout most of the time it can perform fairly well. And of course there are a couple of funds that mirrors the 60-40 portfolio. One of them is BlackRock Global Funds. The other fund that performs quite comparably, it's also a BlackRock Global Fund. Yeah, correct. So it's an unintentional result, but yeah, we just have to respect the fact that these are some of the names that did much better than some of their peers. In fact, three of the not so, or rather the three average funds that we showcased earlier happens to be a Schroeder Global Multi-Asset Fund and Franklin Templeton Fund, and of course there's one Fidelity Fund, right? Correct. So let's keep an open mind because every fund house have got good products and some average products. So they all have their products that they are proud of, right? So correct. Our job is.
What do you think, Jake, about? I'm just curious about fund houses moving into active ETFs, because I think ETF, the active approach
is the next wave. It's the next wave.
Yeah. So do you think
Correct.
that's going to be where the costs are going to come down potentially?
Very much so. Correct.
Yeah.
In fact, this is happening right under our nose right now. One of the highly respected institutional mutual fund manager, dimensional fund advisors, they have already started doing that. I would say, yeah, the future trend will be active managers shifting their fund structure into an ETF wrapper, so that, yeah, correct, so that actually it would benefit all investors because you can access those strategies at a much lower cost.
And I assume it's managed from their end, right, as well, rather than
correct.
Structure. Yeah. Okay.
That's right. Correct. Yeah. So it will benefit most of us. If you ask me, it's definitely a good thing to do so. But of course, I don't have a crystal ball how long this evolution will be. Could be 5, could be 5-10 years, or could be as long as a couple of decades.
Yeah. Okay. Right. Thanks. Just interested.
Okay, thank you. Can we take a look at the next question? I believe we have a few more. How do you assess or evaluate an income fund? How do you tell if the income paid is dividend or return of capital?
Sorry, in this case, is it a fixed income fund or is a fund that pays out, that distributes?
Yeah, like a dividend income fund or an equity or multi-asset, I assume. Yeah.
Yeah, it's not very clear from the question, but let's assume that it's an equity income fund that pays regular distribution. How do we? I will put them through the screener. Even without putting them through a screener, I'll still evaluate some of the key ratios that I mentioned earlier. Put them side by side, and we see whether it's up to par on some common metrics. Of course, the key question is, a lot of people misunderstood the fact that the higher the fund pays out, the better it is. It's not necessarily so, because you got to look at the total returns of the fund. Yeah, correct. So usually what I do is when I pull out all these data points on the charts, instead of using the price, which is not a good indication of their performance, I actually use total returns. Yeah, so total returns includes price change of a fund's NAV and also the dividends or distribution they have paid out. So in this case, you can have a better feel of the risk return profile. Yeah, from there we decide whether this fund is delivering or having a good performance that is acceptable for us. And yeah, all right. So how do we? It really depends, because you could be at somewhere talking to a financial advisor who only give you 3 options, right? Compared to, let's say, you go to a distributor whereby you have like 50 options for funds. Yeah, so it's really hard for me to answer that question, because you got to look at the universe available to you to make a better decision. If you only have 3 options, you got to pick among the 3.
Yeah, thanks, Jake. Maybe we'll just take one last question, and the remaining of the questions, right, we will actually reply the attendees directly. Okay, how about newer funds that ride on themes investing like Allianz Thematica? What do you think of them comparing to the traditional funds like technology, Asia, healthcare, etc.?
Okay, Tim, do you have something to?
Yeah, I mean, I think I could say from a investment perspective, or just a sector perspective. I mean, the established ones like technology and healthcare, they've been around for however many decades. So these are themes or funds that have got well established deep roots, right, in the economy or in the global economy. So I think they're quite they're probably more sticky. Whereas I think some of these maybe more thematic newer funds, maybe a lot of the themes within them are things which are marketing spin, or they're more emerging industries. So I think it's the sort of responsibility is on you as an investor to investigate and to delve into the fund itself and understand the industry that you're investing into, and whether you believe it has staying power, whether you really have conviction on it as a theme or a thematic, and whether it's just hot air, or if it's just hot air. So I think that's an important thing to understand, because obviously I think with a lot of funds, they do come out with a lot of these thematics, but understanding whether it has staying power and it's real, and the companies within the portfolio itself are profitable or generating growing revenue, or in industries that have increasing TAMs, like total addressable markets. I think these are all important factors that you need to take into account.
Yeah, that's right. In fact, if we look at a track record of funds issuing all these thematic ideas or thematic products, somehow the timing it's pretty bad. It's usually launched during near peak period. I would say the timing of new launches is usually badly timed, right? Because it's always a good talking point for anyone to launch a product that is hot, that is popular. So if you ask me, I would rather focus on the overarching theme of technology. Any subsets of those teams, whether it's artificial intelligence, whether it's electric vehicles, or batteries, or some of the popular ones would be like, what else? Semiconductors. These are very good sub-themes, but more often than not, it is too narrow for, let's say, a high exposure for anyone's portfolio. Maybe a 5 to 10%, I think is fine, but a lot of people tend to just, show me the money and just push all the way past their threshold. So I would say, as a tactical exposure, give it about 10 to 15% or nothing more than that to technology, to healthcare, to consumer discretionary. Those are those are big sector or big, you can say it's factor allocation or exposure as well. Because within those sectors, they are actually quite factor centric, right? Things like financials, they tend to be a bit patchy over longer period. Technology is always, in fact, the key driving force of the financial markets and economy. So technology is definitely something what I want to have in my portfolio, but it's a question of, do I want to focus on just EV or focus on semicon? That's a separate story. I would rather top down and give decent exposure to technology and not trying to pinpoint whether it's EV or not, right? Because that would be a very good start. Correct. Because a lot of all these thematic launches and you happen to buy, it's usually towards the peak. I would suggest after a correction sets in, when everyone is afraid to talk about it, I would say those are good, pretty good times to pay attention to.
Yeah. I would add also that I'd agree with Jake. It's the opportunity set as well within these narrow thematics that they're not as wide, and so I think you're going to find yourself concentrated and maybe portfolios adding names that are perhaps not higher quality just because the opportunity set is so narrow. So there's something to think about. Yeah.
Okay, thanks Tim and Jake for sharing with us how to actually pick the best mutual fund. And thank you everyone for joining us this evening. Have a great evening ahead.
Thanks everybody. Thanks for joining.
Thank you guys.
Okay. Bye.
Thank you.
Bye.
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 Bye.